Martin.
I'm Robert Bennett.
I'm Lance Jordan.
I'm Nick Jacobs.
And I'm John Miller. Currently, the target range for the federal funds rate is 1% to 1.5%, with the effective range being 1.07%. We currently see that the Federal Open Market Committee has three options: decrease the Fed funds rate, expansionary monetary policy, do not change the Fed funds rate, or increase the Fed funds rate, contractionary monetary policy. Given that the unemployment rate is at or near the natural rate of unemployment, and that real GDP is slightly above potential GDP, indicates that a contractionary monetary policy might need to be implemented. At the moment, we are also not seeing any strong inflationary pressures in the economy. However, given the strong growth rate of the economy, we recommend the Fed continue its normalization policy. Based on our analysis, we recommend increasing the target range of the Fed's fund rate at the December FOMC meeting to 1.25% to 1.5%.
Currently, the U3 or headline unemployment rate sits at 4.1%. It has been in the 4.1 to 4.9% over the past year and has overall been trending downward since the Great Recession. It is also near the theoretical natural rate of unemployment, which means that the economy is near or at full employment. The U6 rate is currently at 7.9% and has also been in a downward trend since the Great Recession. The U6 rate is worth noting because on top of the U3 rate, the U6 rate takes into account those marginally attached to the workforce and the underemployed. Now, the unemployment rates have been promising lately. However, such a large gap between the U6 and U3 rates may indicate that there is some slack in the labor market, which may be why we're not seeing as much upward pressure on wages or cost-push inflation. The labor force participation rate is currently at 62.7% and has been in a downward trend since the Great Recession. It has been at around 63% since 2016, which may indicate that it is leveling off. And hence we do not see it growing much in the near to medium term. Income and wage growth has been increasing slightly since 2009. However, if we look at the percent change in productivity and wage growth since the 1970s, we see that productivity has increased by over 200%, while wages have increased by just slightly over 100%. And despite unemployment being low, we do not see much upward pressure on wages, which is what one would expect with a tightening labor market.
Excuse me. Calculated inflation using year-over-year PCE inflation is 1.6%, and core inflation using core PCE is 1.3%. Both measures are below the 2% target goal, but remain within the committee's symmetric inflation goal. The trend of inflation and core inflation indicate that there's not an immediate threat to a heightened risk of inflation. There's not an immediate threat to heightened risk of inflation in the near to medium term. We also don't see any inflationary pressures coming from the supply side or the demand side of the economy. Headline inflation increased 2.2% year over year in September, and after declining in the beginning of the year, core CPI remained at 1.7% for the fifth month. It should be noted, however, that CPI typically overestimates inflation by 0.5 to 1%. The three indicators for PPI dipped slightly in the middle of the year, but have been on an overall increasing trend for the year. Final demand increased 2.6% year over year in September, and final demand for goods increased 3.3% year over year, and final demand for services increased 2.1%.
Our real GDP has moved slightly past our potential GDP, which indicates two things to us. Firstly, it shows that we are at our peak unemployment rate, or a natural unemployment rate, and there could be an inflationary gap on the horizon. Since 2016, real GDP has been an upward trend, and we actually exceeded our third quarter expectations and hit 2.2% growth. Our trade deficit has went up by $0.8 billion from August and hit $64.1 billion as of September. Our exports are at $129.6 billion in September, which is up by $0.9 billion from August. Our imports also increased to $193.7 billion, which is up $1.7 billion from August. It's a good sign that our exports are growing, as it means we are producing more within the country and leading greater job growth. Our consumer sentiment has always been a good indicator as well in the past of how consumers are going to spend their money, and has been on an upward trend since 2011. It increased by 4.3% in September, and the index itself has risen to 95.1. This is a really good sign for us because consumer spending makes up roughly 66 to 70% of GDP. Our retail sales recovered at the end of 2010 and returned to their pre-recessionary levels. However, in mid-2011, there was a decline that started again, and it remained below pre-recessionary levels until roughly mid-2016, where we started to see retail sales go back up. Now, there does not seem to be a buildup of inventories, which is a very good sign because it means that we are producing at the same time that we are selling.
Total construction spending has increased by 8.9% over the last 12 months. This is slightly down from the November 2016 numbers when the year-over-year increase was 10%. This suggests that construction spending may be becoming stagnant, and because construction spending is considered to be an important part of investments, this could have negative impacts on GDP in the near to medium term. New housing starts increased by 6.1% over the last 12 months. Although this series consistently displays a degree of seasonality, we saw a significant downward trend from 2006 to 2009. Since 2009, new housing starts have consistently and gradually increased. Although new housing starts are not at their pre-recessionary levels, the consistent and gradual increase indicates that the economy is slowly improving. Since the high of 11.1% in the third quarter of 2009, rental vacancy rates declined until the second quarter of 2016, after which they began to increase. They are currently at 7.5%. Analogously, homeownership rates have increased since the second quarter of 2016. This suggests that more consumers are transitioning from renting to owning homes, which is a good sign for the economy. Furthermore, it shows that consumers are beginning to become more confident in taking on long-term debt, which is another sign of a slowly strengthening economy. From 2006 to 2010, business establishments decreased by approximately 160,000. From 2012 to 2013, we saw further decreases in business establishments. However, with the most recent data from 2015, business establishments are approaching their pre-recessionary levels of 650,000 to 700,000 annual establishments.
The U.S. dollar index has been on an upward trend since 2011. However, since December 2016, there's been a downtrend in the U.S. dollar with a slight uptick in September. This shows that currently the U.S. dollar is weaker relative to other currencies. The price of crude oil over the medium term has been on a decline. Recently, since December 2016, the price of oil has started to rise. It's currently around $56. The medium term decrease in the price of oil has led to lower gas prices, which leads to higher discretionary income available to consumers. Although the recent uptick in oil, if it continues, could lead to higher gas prices, which could lead to less discretionary income available to consumers. Also, we do not see the supply of oil decreasing in the near to medium future, and we also do not see demand for oil decreasing from the production or consumption side. The S&P 500 has been trending upward since the Great Recession. This shows that investors have greater confidence. Additionally, a higher stock market can lead to higher consumer confidence, which can lead to more spending, which can then lead to higher GDP and can also spur job growth. We must note that there could be a potential asset bubble in the stock market, and this could lead to a correction which could have a negative effect on the economy. The 10-year to 2-year Treasury spread has been on decline since December 2013. In October, it was around 0.81%. This shows that expectations for economic growth in the medium to long term are not as strong.
We do have a concern about the reduction in the Fed's balance sheet. In 2008, the Fed started what is known as quantitative easing to help with the effects of the financial crisis. And since then, the Fed's balance sheet has risen to roughly $4.5 trillion. And it's helped provide a lot of stability and growth to the financial markets. However, now that they have stabilized, we believe that the Fed is justified in implementing its normalization policy. Now, unwinding the balance sheet would allow for there to be another tool in the Fed's arsenal, just in case there happens to be a downturn in the economy again.
In conclusion, the reasons that we are optimistic about the United States economy are as follows. First of all, the U3 unemployment rate is at or near the natural rate of unemployment. Second, real GDP is slightly above potential GDP. Third, new housing starts, retail sales, and new business establishments have been increasing. And finally, wages have been trending upward slightly. The reasons we have concerns about the United States economy are as follows. If consumer credit card rates increase as a result of raising the target federal funds rate, this may lead to a reduction in consumer spending, which would have a negative impact on GDP. And second, construction spending is positive, but has been trending downward. Third, there's a potential asset bubble in the stock market. Fourth, inflation is below the target level of inflation, around 2%, which may indicate that the economy is not overheating. And finally, the 10-year, 2-year treasury spread has been decreasing, which does not show strong growth in the medium to long term. Based on our analysis, we recommend raising the upper bound of the target federal funds rate from 1.25 to 1.5%, and raising the lower bound from 1 to 1.25%. Thank you.
You mentioned that we're about at the natural rate of unemployment. And also you say that real GDP is greater than potential GDP. I'd like to sort of ask questions related to both of those. First, how do you know that we're about at the natural rate of unemployment? Conceptually, what is the natural rate of unemployment, and how would we know whether we're at it, above it, below it?
Well, the natural rate of unemployment is something that has to be adjusted as time goes on. We kind of look back and see what's going on in the economy. It's with structural and frictional unemployment, see how all that plays in, and then we adjust that number as it goes on, like I said. And then what the actual unemployment rate is, which would be the U3 rate, the headline unemployment rate. We compare those two to see where it's going.
Well, monetary policy is forward-looking. We don't have the luxury of waiting and adjusting later. So, making a decision now, how are you confident that we're about at the natural rate?
So generally, natural rate of unemployment is anywhere between 4 to 5% as a general indicator for our U3 rate. Since we're at 4.1% right now, it appears that we are, even though our U6 is slightly higher, it just shows that we have a little more slack in the labor market currently.
Yeah, and I would just add that when your economy is producing at potential GDP, then it's pretty much assumed that you're at the natural rate of unemployment. And while that's just a projection, you don't actually know what your potential GDP is until a few years down the road, because it's just a forecast. Potential GDP is just a forecast.
Well, let me follow up on that. If we're above potential GDP, why aren't we below natural rate of unemployment?
Because there's still a lot of slack in the labor market right now. Our U6, since it includes people that have part-time jobs and full-time jobs, it shows that there is a lot of slack within the labor market because of that, so wages aren't gonna go up. But the jobs that we have currently, it just means that we're utilizing them properly. And our potential GDP could be off a little bit. It's just one quarter, doesn't mean that it's a trend yet.
How does one go about measuring the potential GDP?
So generally, potential GDP is calculated by the natural rate of unemployment, which is between 4 and 5%, over our actual rate of unemployment, and then multiply that by our actual GDP.
So for potential GDP, I think let's say, given the same, amount of people, the number of people, and then what are the other fees to that?
You'd also wanna look at productivity, you know, and if we're at, you know, where we're at with the, level of productivity. You know, if we're, you know, it's like where we could, you know, are we to that point where where we've reached like max productivity?
So that could be one of your concerns why, you know, you might, due to these other factors, which is determining the GDP, right? I mean, the fact, even if it's unemployment, is actually another thing is, my question is, so were you, you actually reading the wage, is actually you're reading the wage growth is pretty, at this point, could you put on the upside part?
Well,
While the inflation is kind of on the downside part. So do you actually, am I right in your interpretation, right, where you're saying actually wage points to pretty strong labor market with price pressure while the inflation is the other way, or there's,
well, it's just that, after the Great Recession, there was a massive reduction in overall wages. And since then, we have seen wage growth slightly. It's not, I mean, based on the slack in the labor market, which would indicate that there should be stronger upward pressure on wages. The fact that we are seeing it just slightly does lead us to, have some optimism about where that is going. We'd like to see that continue.
well, the inflation is really different, like your reading of inflation.
Yeah, and inflation, is because inflation is still below the 2% target, and in looking at it and where it's going, you don't see a lot of demand or cost push, demand pull or the cost push inflation, and we're worried about the inflation where it's actually going to end up. And that's why you put it on the downside, is because you are still below that target.
So my reading of your answer is like, because it's two, even though they move differently, but then the benchmark we are judging them by is different, okay? We compare them to 2% target, right, for wage, we compare to some pre-recession growth. Is there any reason to view them differently? Why we would kind of question why the 2% inflation target is the one where you should compare it to some constant?
Yeah, I mean, the Fed sets their 2% target, and they set the 2% target for inflation to help with the price stability. So we're looking at the 2% target, because that is the target that the Fed has set, and that's really where we're looking to get to. And so, yeah, I mean, that is where we're looking to do. That's why we set the 2% target for inflation, is to be able to get to that target. It's not a ceiling. I mean, I don't want to sit there and say that it's a hard ceiling. You will float above and below the 2% target. But so long as you're close and floating between that target of 2%, is really where we want to see. And right now, because we're not seeing the inflationary pressures in the economy, means that we're a little worried about where inflation is going.
Well, why is the 2% target optimal? Why not 0%, 1%?
Yeah, because when you set it too low, you risk actually moving into a deflationary period. And deflationary period isn't gonna be good. Because the prices will decrease on that, your overall prices and stuff. So you're gonna start losing, your aggregate demand is gonna start decreasing because your consumers aren't gonna wanna buy as soon. You're gonna wait, assuming the prices will continue to go down. That's why you don't wanna set a target too low, because if you hit that deflationary period, as the consumers put off spending, you lower your aggregate, GDP rate.
But why not stick with 1% then? I mean, we're not inflation.
Well, I'm gonna go back to the same issue. If you set it low and if you hit a recession and you start losing your inflation rate, you are much closer to that 0% inflation rate and deflation. Having a little bit above it, around the 2% goal, means you have a cushion when you hit a recession. So you have a little bit of leeway before you actually hit deflationary pressures.
You referenced the CPI in one of your slides, and one of the criticisms of that measure is that, like, know, be outdated, the basket of goods that it contains. In your research or in your opinion, do you have any suggestions for changes to the basket of goods and why or not?
Actually, that could be a good point, of actually considering the basket of goods, because your goods do change. I mean, you don't have the same consumables that you did 30 years ago. Updating the basket of goods would be important, and you should keep on top of that and making sure that it's a good representation of the urban household of four, and that's what they're buying. So you would wanna make sure that you're updating that and looking at your basket of goods.
Additionally, we would wanna look at, are we still seeing that a family of four is the major market? Because if it's not, then we need to change that.
Let me ask you a question about the FOMC. How many, Reserve Bank presidents vote on the FOMC?
7, as I recall, maybe 7.
Okay, and do you know how that voting is, well, how many reserve banks?
There's 12.
12. And so how do they choose the ones that are gonna vote?
I believe isn't it just on a system of, they rotate in and out, as I recall.
Okay, and this year, do you have any idea who's voting?
I don't think Chicago's on it this year.
Okay, and who's from?
Minnesota, or Minneapolis, sorry.
Okay. I wanna ask a question about the, yield curve. You have it as a downside. Okay, why is it a downside? Why is it something we're concerned about?
So when you look at the yield curve, you have your short-term bills and notes, treasury bills and notes, and then your long-term treasury bills and notes. And, for instance, like your 10-year treasury, that's gonna measure more medium to long-term, expectations for the economy, since with the yield you have the real interest rate plus expected inflation. So if investors are expecting inflation to be low and the economy not to grow very quickly, and that rate rises and the short-term rate lowers, and that shows that the economic growth is going to be negative. So 60% of the time it usually shows that there's a possible recession, if it's inverted.
What's the, tell me again, what is the mechanism?
What's the economics behind it?
Is
Why,
that a-
why
right.
would it affect the agency economy, business or consumer? Why would that be bad for the economy? So through how it works through the real economy side. Like this sounds.
So your nominal interest rate is made up of your real GDP, or not your real GDP, I apologize. Your real interest rate plus your expected inflation. So if your nominal interest rate's going down, it could point to your real, interest rates are going down, which is something that you could affect, or your inflation is going down, and you would have to figure out how to up the inflation factor, and then show better, stronger economy, track that 2% goal.
Yeah, and I mean, once you're looking at the inflation rate, if your inflation rate is decreasing, you're assuming you're not going to see a lot of growth if there's no inflation. You're assuming that the GDP growth is going to start slowing down.
Are we talking about real GDP growth or?
I would talk about real GDP growth, yes. As you look at the real GDP growth, you'll see that declining. But the expectations for it should decline.
One of the potential downsides is, you know, the stock prices and the potential asset bubble, and when you're playing that out, what would happen if your policy recommendation is implemented? Can you stand more on why you see that as a potential downside?
Well, first of all, if there is an asset bubble in the stock market and that bubble were to pop, if we had already raised the rates, then we would be able to lower them during the aftermath of the ensuing bubble pop, which that is one reason why we are recommending to raise the rates, because currently the rates are low, and that doesn't give us that much of a floor to go to if the economy were to take another downturn. And
So if the asset bubble is based on, kind of due to credit, or like the Great Recession, if we raise rates, that could have a negative effect, just like, with, adjustable rate mortgages. Those increase as the Fed raised the rates, and that caused kind of everything to start to collapse. So it's the same sort of thing, although right now, I haven't really heard much about, credit being an issue with the current asset bubble. I think it's more just people are excited, there's that irrational exuberance, and, the stocks are kind of overvalued. If you look at like, the CAPE index, kind of PE ratio for the S&P 500, it's at about 31 right now, and like I said, that shows that the stocks are overvalued. So, if it's not really based on credit, we should still, what we do with our monetary policy could have an effect, but it's not gonna be as, it won't be as bad as if it's based on credit.
To follow up on Sandra's question, some Fed chairpersons have argued that we can never really tell whether we're in a bubble or not. So, and that we should actually pay attention to stock market prices or asset prices. So, do you agree with that?
I disagree. I think you should pay some attention to it, because there's a lot of money in there, and, people have, pension funds, there's insurance, all these sorts of
Fine.
things.
Thank you.
Thank you.
Thank you.